People are joining. Great. Okay, we're all live now. Hello, team. Welcome. I'm Sam, and this is Andrew. Welcome to our updates. Pretty interesting time, Andrew. We thought it was going to be a pretty boring week.
It was this. It's sheer coincidence that that everything's been going on in the background over the last 2 or 3 days. So
Yeah.
opportune time.
So what we'll do, folks, on this call is we will obviously we're going to have heaps of time for questions because I'm sure there'll be plenty. But what we'll do is sort of take you through what's been happening in the markets, why it's been happening, and what we think about it. And we'll give you the same conclusion that we have to the question, where do you think the markets are going from here? Which is, we have no idea, and who does, right? But however, there are ways to make sure that you don't have to be concerned about that or concerned about it in the long term anyway. So, Andrew, could you just describe, like in the last, it's really been in the last week, right, that financial markets have really been having a rethink, and sort of interesting, like, because they all haven't gone down, have they? Some of them have gone up. Some of the investments have gone up.
Some investments have gone up. Yeah. So share markets have had a little bit of a few down days. Just watching people logging in. I might just give it 2 or 3 seconds more.
Okay, we've got some more people joining already. Okay, let's carry on now. Stabilised. Okay.
Yeah. So the markets had a very good run, particularly the US market and particularly technology stocks until a little while ago, a matter of days really. And the market was working on the premise that the US and therefore the US Federal Reserve, the central bank over there, they were going to ease monetary policy, reduce interest rates towards the end of this year, but that they were doing very well in creating what they call a soft landing. So just a slowdown without any form of crash. Every month, the US produces an economic statistic called the non-farm payrolls, which sounds a bit strange, but it's basically their unemployment statistics. They come out on the first Friday of every month. And they set the tone for economic releases for the month. There's a lot of data in there that people use for working out how the US economy is going. And on Friday last week, the non-farm payrolls number came out, and it showed weakness in the US economy that surprised everybody. Unemployment rate is up. The rate of employing people is down. And it's probably symptomatic of the fact the market was a little bit overhyped anyway, but it caused a fairly dramatic sell-off, particularly in the US on Friday. And then yesterday, even more dramatic sell-off, particularly in Japan for various reasons. Japan seems to be particularly sensitive to this. So the markets are all down. Well, Japan's down about 12%. The US is down about 5%. It's been, as I say, very volatile, very extreme moves in a lot of stocks, and the technology stocks have taken a real pounding.
So you have a scary US economic data. So that's the first ingredient in the soup. Let's add the other ingredients in the soup, which causes all this other fear. As Andrew alluded to, Japan started putting up its interest rates for the first time in a very long time, right? Decades and decades.
Yeah.
No one's used to that. That creates uncertainty. And as you know, financial markets hate uncertainty. So suddenly you think, well, maybe the Japanese economy is going to slow down because all of these Japanese companies, which have been used to basically having free money to borrow, almost free money, will have to start paying interest on it. And will that cause a whole lot of problems and slow down for the Japanese economy? You have that, right? Then you have the US elections, right? And so there's all uncertainty there, Trump and Harris and all that sort of thing. Financial markets get very nervous and jittery until they know about political certainty. Then you have Warren Buffett, one of the world's great investors. Suddenly we find a couple of days ago that he sold half his position in Apple. And a lot of people think he's the master full-timer. They will think that even more now. And so everyone gets the heebie-jeebies about tech stocks as well. So you've got worrying economic data, you've got rising rates in Japan, you've got political uncertainty in the United States, you've got, the world's most famous investor selling a whole lot of stocks. Is there anything I've missed? There'll be one or two other things in there as well, which just creates this huge soup of uncertainty. And of course, one of our great phrases, and you will hear this pretty much every one of these ones, is that short-term, the markets are a voting machine. Long-term, they are a weighing machine, right? So long-term, stents will prevail. So the journey to getting there could be very volatile along the way. And that's why, I don't know, did you sleep okay last night, Andrew? Of course, I slept okay as well, because we know that your money is invested in very diversified portfolios. You know, for example, our diversified funds, your growth, high growth, balance, and so on, have 4,000 investments in 20 different countries. And, you know, a lot of them went down, the stock markets went down, but the bond markets actually went up a lot as well. So somewhat mitigating it. And we have investments in, you know, in build to rent housing and in mortgages and so on and so forth, which will be much less volatile. So don't read too much into today. I think today was the letting out of quite a lot of air from the balloon, and they've been trying to let it out slowly. You know, as Andrew talks about the soft landing, we always like to have a soft landing when we land on an airline. What we've had is a crunchy bang right now, which is maybe, which has given us a bit of a scare. So our you know, standard, you know, phrase in these things is, you know, keep calm, carry on, don't panic. And goodness knows, Andrew, like Simplicity's almost 8 years old now. We've had Trump getting elected, we've had COVID, we've had inflation, we've had like big market resets like this. In fact, I was watching a presentation by Peter Lynch, who's a very, very famous investor of old, and he was actually reminding the US Congress, this is way back in the 90s, be saying, you do realize that we have like a major like down day of more than 2% every 2 years, and we have every 6 or 7 years the stock market goes down to 25%, and that has been the pattern all through history. Not, you know, obviously you can't set your watch by it; it wobbles around. But this sort of volatility that we're seeing is not particularly unusual, judged by the fact that we have about 75 people on the line right now. Back in the old days of COVID, it'd be more like 700 people on the call, right? So I think people are getting used to this and realizing that if they have a diversified portfolio. But Andrew, could you show us like one or two charts?
Yeah, I've thrown these together very quickly, so I apologize for the quality, but I just thought it would be interesting to just have a look at try and get a little bit of context to this. So this is just the global share markets around the world for the last 3 months. And as you can see, that move by Japan overnight is pretty dramatic. All across the board, pretty much everything is down from the beginning, starting at 1. I've indexed everything to the same. So Germany down, the UK down, Japan dramatically down. The US, the two US indices there, I picked the NASDAQ because it was the one that was going up the most, and it's come right back down.
So Andrew, just to explain this chart, on the left-hand side, when it says 1.15, say, that means up 15%, right?
5. So 1.15 is 15%, yeah. So the NASDAQ was almost up 15%, and is now down fractionally from 0 over the last 3 months. I just thought it was interesting just to look at that because it gives some context as to just how big the move was last night for some of these markets. But
it's sort of interesting, isn't it? Because 3 months ago, if we said the financial markets will be flat for the next 3 months, everyone would have gone ho-hum, not worried about it. But the fact that it goes up 15% and down 15% it gives obviously people cause for concern.
So over the last 5 years, and again looking at those scales, it just shows how much markets have gone up over that time, with the exception of the UK, which has had its own issues. The NASDAQ dramatically higher. 150% higher over the course of that 5 years. And so this drop in the context of the last 5 years, even for Japan, they're still up 50% from 5 years ago. It just, I thought, gave a little bit of context as to what has been a very big move overnight, but that is still in that longer term picture, a blip.
So that begs the question, doesn't it, Andrew? You look at that and you think, oh, look at that, NASDAQ, it's up 150% over the last 5 years. Shouldn't we be getting out anyway? Aren't the markets right this time? And the answer is you sort of have no idea. You could have said that back in 2021 when the markets were up 120%, then they went down, but then you know what? They went back up even higher again. It's very hard to know. What you do know is there's this long-term technology-driven theme in investing with tech stocks, and that's been going since, 1996, 1997. You would have been mad to be underinvested in that. But the other interesting thing now is that just as we get to this, you can say the markets are very toppy. And by the way, we have no idea where the markets are going. We are not changing any of our investment strategies based on what we've seen today. We just stay, obviously, overwhelmingly and passively invested. But what's interesting is there's now central banks have got a lot of gas in the tank, haven't they? They've got a lot of the ability to stimulate the economy with interest rates.
Well, that's the big change. If you look at that chart there, right at the very beginning, that the COVID drop, interest rates at that stage were already very low and went lower until about September 2020. So central banks had very little ammunition really to stimulate the economy at that point. I sort of thought I'd just look at this one. Sorry, I've got them in the wrong order. This is the last 3 months for global bonds versus global shares. And you can see global shares were doing extremely well. Been coming back over the last few weeks. This is just a 3-month chart. The blue line is the value of global bonds. It's an index that just measures how they're performing. And as you can see, over the last 3 months now, they've done what they're supposed to do. They've actually offset at least some of that drop in the share market, and going up. If we go up,
Go backwards, maybe.
Yeah, that one. So this one again, same as the previous chart, is the last 5 years. So again, you can see that dramatic sell-off in global shares when COVID hit, and bonds have done nothing really over the last 5 years. They're only just now beginning to show their head above zero for that period, whereas shares have dramatically outperformed. And I just thought it was interesting to look in the context of why would you have bonds? Well, you have bonds to protect you from these sort of instances. When interest rates were virtually zero, they didn't provide much protection at all. But at least now, with interest rates up at around 4.5%, 5.5%, there is some protection from the bond market.
Yeah, but there's a long-term story there as well. And if we took further back in history, that would show you that while you should have a diversified portfolio, and we do, you are rewarded for the risk you take by owning more shares.
Oh, and I think that one.
So, and this shows it's right. So the long-term story, we'll just go back to us now, I think, those...
Yeah, that's all I have.
Yeah, so look, so the long-term story remains intact, right? The only free gift in investing is diversification, and we've got that. We've highly focused on that. Secondly, you will be rewarded for taking more risk by investing in shares, but there will be times when shares underperform that, remember, the bond markets could actually be quite supportive. You should basically stick to your knitting. So for us, this is a keep calm and carry on moment, really, isn't it, Andrew? Yeah. There's nothing that is overly concerning us in the sense that the world has not changed. What there is a lot of uncertainty in the world about certain things, and you could draw an Armageddon response to that. You could sell out of all your investments, go into cash, and hey presto, the market could bounce, 5 or 10% in the next few days. We just have no idea. So as long as your investment strategy for yourself is correct, and if you want to think about what's the right fund for you, then go to Sorted or go online with our and go through the fund selector, and it will show you, long term what the best fund for you should be. And so we're just highly cautious about anyone who would make a very short-term decision if they're investing for the long term. So, you really, really get back to basics here as well. We also thought we'd use this opportunity to just talk about what we're doing in our sort of non-index. So about 90% of our investments are in passive investments, domestically and offshore. We have 10% in Simplicity Living and in our mortgages and our private equity and venture capital funds, and that mix changes depending on the fund that you're in. But just very quickly, just to run through those, in Simplicity Living, we're going gangbusters. We're building now another 297 homes here in Auckland. We've already completed 210. We have the land for about another 600 homes behind that, and we are looking to acquire more land, both in Auckland and also around New Zealand. Auckland seems to be a relatively easier place. There's more land for sale, absolutely, but also the rents that you can earn on the buildings that you build are a little bit more attractive than they are elsewhere in the country. That doesn't mean that we haven't written off the rest of the country, but far from it. We're sort of, or seems to be visiting new cities pretty frequently and having a look at what that market looks like. And we have a long-term intention to build across New Zealand. But that's going well right now. We're in build phase. One of the nice things about that is because of the development margins we make, the money that we spend on developing, we accrue a 10% return to that, and that passes through into the funds that are funding Simplicity Living, and of course the rents are all being paid and so on. So that's all looking really well, going to plan. A big development amount. Wellington is on time and on budget, which is wonderful. In our mortgages, it's really interesting actually. As you know, we lend to first mortgage borrowers. We have about $200 million worth of mortgages out there. And it's interesting that in the last quarter, we have the rate at which we're writing mortgages has gone up by about 3 times. So I think a bunch of people are finding out that we have that product out there, that it's attractive, and we've just seen a real pickup, haven't we, in that mortgage lending, which has been interesting. And then in private equity and venture capital, we just continue to give money to Icehouse Ventures. We've just committed to give them another $10 million for one of their funds. It takes our investment in them up to $35 million. And then we continue to look at private companies in New Zealand. We have 6 of them now. This is a very long-term strategy of taking minority stakes in great family-owned businesses in New Zealand. That just carries on as per normal. So, it's a relatively undramatic time around here because we manage money in an undramatic way, very focused on charging you the lowest possible fee, which is where you think you'll get the most upside. But where we have an enduring competitive advantage, then we'll get involved. So why don't we pause right now and just ask you if you have any questions. Please, if you could just type them in there, or you can either stick your hands up or send us a message there. And and someone says they'll try YouTube, so people will do that as well. So, Andrew, anything else you wanted to comment on in terms of how we're managing markets or the financial markets generally?
No, not really. I mean, as I say, I always most of all want to find out what people are interested in. I mean, if you're immersed in it, if you're up to your neck in it the whole time, that's a good question. But if you're in your neck up to the neck, I'm literally reading stuff all day, every day. It's always interesting to find out what is resonating with our members.
So here's the first question. It's a little personal, but what is Simplicity succession planning for Sam Stubbs? Well, we have a succession plan. It is firmly in place. We have 2 people identified that could take over for me if I disappeared off into the ether tomorrow. And it's really critical from Simplicity's point of view that it's not a single person dependent, which it certainly isn't. We're an amazing team. I happen to be the voice or one of the voices of the business, but certainly the business goes on whether I'm here or not. So there is a succession plan firmly in place there. From Melanie, I'll read the questions and you can answer them, mate.
I can do that.
With the index funds, do you buy and sell according to the index? How does that work when there is a sudden sell-off?
Yeah, good question. The thing with the index is that if you like, taking the New Zealand share market, which is the easier one to talk about, we've only got 30 odd investments there. As they sell off, they all adjust accordingly. So if Auckland Airport goes down relative to Fisher and Paykel, obviously our holding of Auckland Airport goes up relative to Fisher and Paykel, and it automatically rebalances as we go. The key is that as everybody's, particularly for KiwiSaver, as money comes in, we've got to keep it invested. So each time we get a slug of money into the funds, we allocate it according to how each of the different asset classes has gone to try and make sure that we keep our asset allocations as even as we can. But within each fund, each of the different asset classes, the fund, to a degree at least, adjusts as the share price or the share values or bond values of each of the components move around.
And if it gets out of kilter, we do a rebalancing trade.
We rebalance the funds 2 or 3 times a week if we need to.
Yeah, so we're looking at it every few days and making sure the proportion is correct. So from David, any thoughts on the noises emerging from the government about using super funds to underpin infrastructure development? Would we be interested? Yeah, the answer is yes, we would. If you look overseas, superannuation funds typically have about, we think, sort of between 3 and 5 times as much invested in infrastructure as we do in New Zealand. It depends to a certain extent what you call infrastructure. So, for example, are power companies infrastructure companies? Some would say yes, some would say no. They'd say it was a separate sector. And so, is a bank part of the infrastructure? Well, certainly part of the financial infrastructure, but it may not, fall within other people's definition of it. But generally, yes, we'd be interested. And we are engaging with the government when we get the opportunity and saying, hey, listen, $120 billion worth of KiwiSaver money out there, that's going to grow all the time. We have these infrastructure needs as a country. Why don't we work out a way of getting those together? Because it would be Kiwis investing in the hood. It'd be local, there'd be no, offshore money in there. There's a political sensitivity about infrastructure, about whether or not you should allow anyone but the government to build and own these things. There's politics in there, but should we be interested? Yeah, we should, and we're having a conversation about it. Bearing in mind that the great thing about infrastructure is if it's not the users paying for it, like, when you have a power line outside your house, you pay a charge every month to make sure that power line. So not only is it a great source of and reliable source of cash flow, particularly when the markets go down, people still pay their power bills, for example. But also, so it's great at getting close to the cash, but there is political sensitivity about who owns that. Even if it's a KiwiSaver fund, a lot of people think that should be owned by ratepayers or taxpayers or whatever. But yeah, no, we should be interested in that. From Facebook Anonymous, at what age would you start moving from a growth fund to a more conservative fund? Well, is it about age, or is it about other things?
I mean, we have to be very explicit. We are not allowed to give any advice to people. But fundamentally, as Sam alludes, it's very much more an attitude of your risk and how long you want your money to last. Provided everything we believe continues to be the case, you will earn more over time from being in growth assets than income assets. However, they are more volatile, as we're finding out right now, and therefore it's a very delicate balance that needs to be struck between getting the most out of your money over the long term and not suffering that volatility in the short term. And everybody's sensitivity to that is different. So unfortunately, it's extremely personal.
And the best thing you do is go to Sorted Fund Finder or go to our website, answer the questions, and it'll spit out what fund it thinks is best for you. So, David, this is from David, do we have risk management strategies in place for mortgages, given the likelihood of buyers being in negative equity for a while? We sure do. So, first of all, is we only lend on first homes. First home buyers are traditionally the last people to default. They're the safest form of lending because, of course, you need a roof over your head and it's your first home. So you tend to prioritise paying the mortgage over everything else. Secondly, we only lend up to 80% of the value of the house, so it's conservative lending, and that's evidenced by the fact that we haven't had any default loans since we've started up. So yes, we do. We have a very strict method, and we run what we call a very conservative lending book. It's awesome if you're a first-home buyer and have got that deposit because the interest rates are low, but we have also the interest of our investors to protect because it is their money we're lending to the first-home buyers, so we're very cautious about that as well. Here's one for you, Andrew. From Facebook, investors have taken a bit of a bath today. How does my Simplicity Kiwi account update? It looks like nothing's changed, which would be great, but not likely given I'm in growth funds. And you're absolutely right. It's not likely. It will change. How does it change?
There's a 2-day delay between the price when markets move as they just have and when it's reflected in the value of your investments, because it takes that amount of time to work out exactly what everything's worth. So I'm afraid to say, yes, you're absolutely correct. It would be wonderful if nothing had changed, but it's likely you will see a markdown in your investments over the course of the next 2 days.
And a question here, thank you, Melanie, thanks for your thanks. And the question here, I have a large amount of KiwiSaver with Simplicity. I have been advised that this is too risky and I should diversify my KiwiSaver amongst providers. What do you say to this? Well, you say, two things. First of all, you can't diversify amongst providers. You can only stay with one provider. Some of them offer you the chance to have multiple funds. We don't. We just have a wide range of funds that you can choose from. And secondly, also, how much diversification is too much? If you're with one of our KiwiSaver diversified funds, you have 4,000 investments in 20 countries. there's a point at which additional diversification, the benefits of that, may not compensate for the extra fees you may pay because you are with multiple providers, even if you could be, there are lots of other providers out there that charge higher fees. So diversification is a free gift, but like all gifts, if you receive too many gifts, they can start not feeling like a gift anymore, and you're not getting the benefit or the joy of them. So, I'd say, first of all, you can't split KiwiSaver providers, so it's not really an academic question here. But even then, we diversify in what we consider to be an optimal way. So another question. I also have another significant amount to invest. Should I take that to another provider too? We cannot give you financial advice, but you know what you're getting with Simplicity. I think the other thing too about KiwiSaver investment and all of our investments here is that, remember, there's also a trustee, in our case, the public trust. We never touch your money. All of your money sits in a trust account in your name, effectively for your benefit. So even if Simplicity went bust, even if something happened, your money would just still be held by public trust, and they would just appoint another manager to manage it. So when you have diversification and when you have an independent trustee like that, there's a good deal of protection and safety. A question from Sho. What's your view on expanding your business to overseas, targeting for overseas investors, especially from rich countries, to invest in the Simplicity New Zealand funds? It's KiwiSaver and or investment management funds. You want to handle that one, Andrew? Or
well, we can accept investors from overseas in our investment funds, but we're really designed, and the reason for setting ourselves up in the first place was to benefit New Zealanders. It's certainly not an area that we've really focused on. For non-resident and citizens of New Zealand are not allowed to invest in KiwiSaver. Residents abroad, or citizens abroad, can invest, but you've got to be basically a New Zealander to be in KiwiSaver. As far as the other funds are concerned, no reason why not. But at the same time, in most jurisdictions of the world, there are similar funds to ours. So there's probably not a lot of reason why they would appeal to overseas.
We have a great competitive advantage here in New Zealand, where we're very low costs and all the benefits. But overseas, there are others like that who will have better distribution. So we don't really spend a lot of effort doing that. If someone wants to invest and they can, we're very happy to. But it's not really something we focus on. We want Simplicity's energy to be going into providing the best financial solutions for New Zealanders. From an anonymous from YouTube, so you think it is a risk that index funds are so highly focused on the tech sector, or is it simply a reflection of the highest market cap? So why do index funds have so many tech stocks?
Well, you answered your own question. Absolutely. Over the course of particularly the last couple of years, the likes of Microsoft, Apple, nowadays NVIDIA, they have dominated the indices and become the biggest stocks. So therefore, that's why they are the biggest investments in our funds. Our funds cover all sectors, and so they, outside the ones we exclude, of course. And so it's simply that those have been the strongest performers over the course of the last 4 or 5 years. We don't, for example, invest in the NASDAQ. As I say, the stocks we invest in, for example, the US, are part of our US allocation, and just in there as their proportion of the market cap.
So from Sophia, it is, what is the key difference between you and the bank providers of KiwiSaver? Well, let me just summarize it quickly. First of all, we charge lower overall fees than any of them, in some cases significantly lower. We give 15% of all of the fees we do get to charity. I'm not aware of any banks doing that out of their KiwiSaver scheme. We invest similarly in some areas with some of them, but then we also have that's the 90% index and passive. There are some other banks that do that, but equally also we have this approximately 10% of our funds under management are managed in a way where we have an enduring competitive advantage. It can make money and do good, like Simplicity Living with build-to-rent housing, first-time mortgages, venture capital, and private equity. Those would be the principal differences. The only thing the bank can do, and I get reminded of this every week, is that they can stick a KiwiSaver balance on the app. So that's how they convince a lot of people to stay there, and that's great. But for that, they're paying higher fees, not giving as much to charity, and helping the bank make profits to send it over to Australia in most cases. So those are the principal differences. Did I miss anything obvious there? There's some
No, I don't think
pretty
so.
big ones over time, yeah. It's a question. Can you please update us on your Israeli investments? Yeah, so I'll have a go on that, and then Andrew can as well. So we've received quite a bit of attention on this. You may have remembered that quite a while ago, the screens that we had three stocks in Israel that were identified as being supporters of the war in Gaza, or those companies were involved in that. We had a look at those, and those were eliminated from the portfolio. And then we had attention drawn to us, and I think in a pretty aggressive manner, that we held both Israeli government bonds and a couple of other companies in Israel that had supposedly exposure to the weapons industry. What we did when we go through that is we employ basically an offshore manager who employs a company that looks at our ESG filters, decides what should be in and should be out. We also pay close attention to what the New Zealand Super Fund does by way of investments as well. And all of those investments that we had seemed to be acceptable and passed through all of those screens. But that was not the view of these other people who thought that these companies were involved in basically weapons manufacture. This is a very interesting issue because people very quickly make this about politics, the politics of whether they agree with Israel or Palestine. We do not do that. We have ESG screens, we have ethical screens, and we run it through and we pay people to ascertain whether these companies are involved or not. Some people think differently. So, for example, there is a company, I use an example, that makes wheels, right? It makes wheels, metal wheels. The fact that it supplies those metal wheels to an armaments company makes that company involved in the invasion of Gaza, for example. So if your ethics string through the consequences of that, they don't, to be completely frank with you, they don't also seem to mention the fact that any company that manufactures plastics, which goes into or any sort of metal or any sort of steel or the fuel or anything that goes into those weapons whatsoever, you could draw the same conclusion and think that pretty much every company or anyone that supplies them with food or Coke or soldiers eat McDonald's or whatever, you can draw a very, very long bow on this and create causality if you want to. We don't make those judgments down here in New Zealand because we don't think we're qualified to. We actually pay people to make those judgments about when there's involvement in, and we have very strict ESG screens there as well. So at the moment, Andrew, we have some Israeli government bonds, which are owned by many, many people, and we have holdings in one or two companies, yeah?
Four companies, I think, last heard, and we've had them all screened, as you say. And the one that was giving the most potential apparent issues, I got our people to screen it, and it came out well below the threshold for being excluded.
Yeah,
I think it came out as an A, and you've got to be an E.
Yeah.
So it's just hard. We've set the rules that are in our responsible investment policy. We stick to those as far as we possibly can. Make sure that, as Sam says, our external providers stick to those, and we've made that very clear.
And so this is that we have a process. We don't get involved in the politics, and we make these decisions based on fact, not on emotion in this regard. So now we realise that some people disagree with that, and they, in their politics, would have no direct association with investing in anything in Israel. Likewise, of course, if there were listed companies and bonds in the Palestinian Authority, if we held them there as well, there were some people who wouldn't want us to own any of those. We understand that, acknowledge it, but we do have a process here that we're going to follow, which is fair to all parties, because we can't be making decisions based on protest or objection or whatever. We have to go through, we have to apply this policy uniformly to all of our investments and consistently. So do we have any other questions? We have no other open questions, folks. So I think that will be about it. So we'll just wait another 10 or 15 seconds if anyone wants to ask us any more questions. I said we've answered 15. Pretty good, Andrew. So folks, just keep calm and carry on. Make sure you're in the right funds, stay invested. Remember this, just leave you one other interesting note. When investments go down, if you're an investor, you want them to go down. You say, why do you want that? You want them to go down because then you're buying them at a bargain. This is what Warren Buffett, remember Warren Buffett who just sold some Apple shares? He says, I rejoice when markets go down because what I was prepared to pay, say, $1 for last week, I can now buy cheaper. So if you want to buy anything else in life on sale, and we do, right? We love sales. Why wouldn't you want to be buying investments on sale as well? That's exactly what happens when the markets go down. So if you are a long-term investor, as weird as it sounds, you should be happy about markets going down. But of course, we as human beings have this thing called loss aversion, and that means that we hate losing a dollar much more than we love making a dollar. So when markets go up, it just seems very normal and right. You feel a little bit lucky. And then when markets go down, you panic. That is the fear motivator, which is designed to protect your survival. And so when you think, oh, I've lost money, you start worrying about, your very financial survival. You've got to use your mind to overcome your emotion in that regard and realize that, as Andrew showed, right, all we are is where we were 3 months ago, right?
Right.
Nothing has basically happened in terms of returns. Who knows where it will go from here? But you know how you sort of quietly enjoyed it being on the up now? Don't worry about the panic and the emotions you have. Keep on investing if you can, because over the long term, the short term, the markets are a voting machine, and everyone's now voting. Not everyone, but a bunch of people are voting panic. Long term, they are a weighing machine, and the weighing machine basically says that you will get rewarded for the risks you take. That in spite of all other types of economic systems, capitalism has many faults, but it tends to be the one that works the best of all the alternatives, and you will be rewarded for taking on risk and just keep thinking long term. So keep calm and carry on. And that's about it, folks.
That's great.
Thanks, Andrew.
Thank you, everybody.
Right.
Thank you very much for tuning in.
See you. And any questions, go to simplicity.kiwi, where our wonderful member services team are ready and waiting. Cheers.
Thanks.
See you.